Hello investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the volatility index, ticker symbol VIX. I'd like to first start off by pre-framing with some information in that this is the first time in months where we didn't hit a single target in our forecast for the major markets. Now, with that said, during the course of the week, through different Q&A sessions and webinars that we've done, we hit the mark for many price targets on individual stocks. But here's what we're seeing today, especially in the VIX. We closed on that little candle right there with a long shadow underneath the candle, and that's the second day in a row where we saw the VIX rally towards the end of the day. Now, if I look at the forecast from last week, you can see that's what I drew with the end of the line at 32.17. My forecast for next week on the VIX is going to be more or less running a line parallel at the same angle and even matching that target. And this is a 2-week forecast, by the way. See that? So that target is going to end on October 28th. Now, I'll erase this line and let me show you something that I normally don't do, but I felt that it's important that I show you what I'm looking at here. And that is, in the cycle of the VIX, I'm going to use what's called cycle brackets. Now, back in the day, we used Ehrlich cycle finders. They were more or less mechanical contraptions that you'd put on a table like an accordion and you'd connect the lows. Now, when you're measuring cycles, you measure from low to low. All right, so I'm going to start at this low right here, and I'm going to drag the cycle lines out. You see that? And then what I'm going to do is match as many of those lows as I possibly can. Now, I'll eventually erase this, but I want to show you. If you look, I'll draw some vertical lines as well, and maybe I'll even leave these on for next week. We'll see how that goes. But if I draw some individual lines based on the time, look at each one of these troughs here. I'll draw a vertical line, and you'll notice that this cycle is very interesting in that if you had bought the VIX on each one of these lows, you would have seen a rally to follow. That's number one. Number two, you'll notice that in each one of these troughs for the bottom of the cycle, you'll notice that the CCI and the stochastics were all oversold, with the exception of this one here, where it was already crossing with a buy signal before that bottom was reached. Now look what's happening right now. We're right at the bottom of another cycle. Now you can see why I'm drawing my forecast line right here. And I know this chart is a little messy right now and probably more of a mess than I would normally draw because I just usually draw the forecast lines and that's it. But I want everyone to see how the markets are more or less reacting or behaving in a cycle pattern. That's number one. I could actually overlay that same cycle on the S&P and have it go reverse, where you'll see that the opposite cycle, remember the VIX is inversely related to the S&P, so if we're finding a cycle low on the VIX, we'll probably see a cycle high on the S&P. Now with that said, let's go right to the S&P. And again, you'll see that our targets were not hit, but look what's happening right now. As I zoom in, you'll see that we did not come back to fill the gap. Let's erase that and redraw this line. Now watch. You'll see as I count, 1, 2, 3 green candles in a row. A minor gap up, another gap up, and a gap still below the market. So we have a series of up gaps, and right up until yesterday, the volume was decreasing. See that? Now today was an increase in volume for, it could have been many reasons. It could have been some short covering, it could have been combined, speculation for next week and such. But notice the CCI here, how overbought that is. Notice the stochastics, how overbought that is. So if I go ahead and I start drawing some lines with regard to the divergences from this moving average, I'm going to show you something right now. Look at the divergence from that moving average, just like that, to the high. I'm going to duplicate this, exact same drawing. See this? I'm going to duplicate the drawing, same length, and I'm just going to shift it over to the left. And notice, look at that. See, the last time the markets had that price divergence so far above that moving average, what happened? We snapped back right to it and then continued below it. So my forecast for next week on the spiders is going to be lower. I think we could easily see the same angle that we did back here. See this angle? I'm just more or less duplicating this and running it parallel to this. And I am stopping very close to this moving average. Now, this is not a guarantee we're going to go lower, but here's how someone who has a long position would play this. If we think it could go lower and we have a long position, but instead it goes higher, well, guess what? You're still going to make money. But if you think it could go lower and you have a long position, the charts are basically telling you to trail your stop up or take some of your profits or cut your option long positions in half, take some of those profits or roll up, whatever it may be. The charts are telling us to do something because of this wide divergence and because the oscillators are showing such an overbought condition. All right, so that's the spiders. We look at the Qs, QQQ, right there. We did not, again, come back and fill this downward move that I thought we would. And that's okay, again, because what's happening right now, again, a steady drop in volume in the up move or the up leg from here. We don't have such a major wide divergence from that moving average, but look what's happening with the CCI. You see that? We have a higher high here, but a lower high on the CCI. It's slight, but it is still lower. That's known as a price divergence in the CCI. That's taken as a negative. So I think that the SPY will see more of a sell-off than tech. And so because tech is so in vogue right now, if you will, I still think tech could be the place where the uncertain or the doubtful money could start moving into some tech stocks, driving that a little bit higher so that we get a wide divergence from that moving average. And then I think towards the end of the week, we'll see that. Again, I'm not looking for dramatic moves in the Qs, but I do think that we have to pay attention to the technical signals right there. If I look at the IWM, there we go. This is the Russell 2000 ETF. You can see, again, I'll erase these lines because they're no longer relevant, and you can see the divergence again from this moving average. See that? Now here's another interesting thing, in that we see mixed signals in some of the markets and maybe some individual stocks, but look at this angle at which the Russell rallied. We have a gap below the market right here, and look what's happening on a higher high and a higher low right here. See that red candle? It's very close to a hanging man, which would be bearish. But we have a higher low and a higher high. Look at that CCI. See, the calculation in that formula measures momentum. And while the price had gone up today, the CCI is actually going lower on, guess what? Lower volume. So if I draw this line, that vertical move away from that moving average, and I duplicate that, watch what happens. Look back at the past. What happened back here? Bam, just like that. You see that? Same distance from the moving average, same drop in volume that we see today. And what happened? We had a reversion back to what some would consider to be the mean or the 20-period moving average. I look at it more as fair value. And so what does that mean? Move your stops up. If you have any long positions, if you're an option trader, you might even consider buying some puts or taking some profits in your calls. I'm going to go back and duplicate this angle. A lot of people ask me, well, how do you draw that angle? How do you draw the speed line? Well, I'm going to try to draw the same angle, but only go out about 5 days. Okay, so I'm going to say, boom, 1, 2, 3, same angle. My eye is looking to the left as I draw that angle, and I'm going to drop it right there. So we have the end right around the 15th of October, so it's close to the end of next week, and then we'll have to see what happens. But again, that looks pretty plain to me that we are overbought on all categories here. And with the gap below the market, ultimately, I think we could even go so far to fill that gap before we see another bounce. Now, if we look at the diamonds, ticker symbol DIA, we had some connectivity issues last week, and I even duplicated this report on DIA. I'm going to erase this line. I will go ahead and keep that gap fill number right there. See that? I'm going to keep that level in place because that will act as a support level. Now, with that said, I'm not going to draw the vertical lines, but look at how far the Dow is away from that moving average. Look back here, same distance, back here, same distance. This was a greater divergence, but then boom, it snapped back a lot faster. And in other words, what happens is the further away it gets from that moving average in a more dramatic and vertical angle, the harder it snaps back in most cases, because we have such aggressive profit taking on these big up moves that those who are long don't want those profits to get away from them, so they sell very quickly. Now, if I zoom in a little bit more, that's known as a spinning top. If any of you have taken a candlestick course, that's a sign of indecision. We usually see spinning tops like that at pivot points. Look at this back here. See that? I'll magnify that for you. That's almost the exact same pattern that we have today. We have a wide divergence, gap below the market. I'm going to duplicate this angle in my speed line, and I'm just going to forecast that out roughly 5 days, just like that. And I think that as the stock stays over the 20-period moving average, this moving average will roll up and eventually meet right there. So October 15th is the date. My price target is 280.56. If you need more clarification on those targets from the markets I've mentioned already, just hit the rewind button, freeze it, expand the chart, and you'll see it pop up in that little box. Okay, that's it for this week. As we get closer and closer to the presidential election, the general election, I think you'll see more investors moving to the sidelines, mainly out of uncertainty. That is another reason why the VIX is moving at the lower levels, because the VIX is also known as the fear index. So from what it looks like so far, the market is more or less expecting no big change in the White House. Now, that could shock the market if in fact it goes the other way. But right now, it looks as though investors are pretty relaxed. I don't see any major selling, panic, anything like that. The news is crazy, of course. Every time you turn on a news station, there's something more volatile in the news. But it doesn't look like the markets are heating up, at least not now. And again, another reason why you should protect your profits, especially after an up move that we've had this week. So have a great weekend, and we'll talk to you soon. So long.